Good morning, friends. Today, on 2nd July, early morning, I'm recording this video. This is the fourth video in our fortnightly webinar video series. Just like our webinar, I will start with the international cues, events, and how global markets are shaping up. Then I will invite my colleague Nagraj to share market view from the technical charts perspective. And in the end, Ajit will share his readings from derivative markets. In the last, we will discuss the way forward. We have already released a strategy note on June 16th. What are the stocks to be accumulated? We will discuss that strategy note. So let's directly jump into the performance of the global markets. Let's start with the S&P 500. So we know that from beginning of 2022, S&P 500 and other markets around the world are in the downturn. So what are the dark clouds? Dark clouds are the worries that are growing that the Federal Reserve's fight against the inflation would push the global economy into recession. So these worries have now led to markets around the world declining. We know that the S&P 500 has closed out the first half of this 2022 and it is the worst performance since 1970. It is a drop of 20.6%. And S&P has fallen 20%. The Nasdaq has actually fallen by 29.5%, and it is also the worst first half performance on the record. Similarly, the global markets, the MSCI Global Index is down by 20%. In our market also, we are also grinding lower. The June month, we ended about 5% lower, and for the quarter, we are down about 9.4%. So though we have outperformed, but still we are down by 9.4% this quarter, and primarily because the foreign portfolio investors continue to sell heavily in Indian markets. So amongst all this doom and gloom, there are some silver lining. The Fed's preferred inflation gauge, the core PCE index, has come in little lower at 4.7% for the 12 months ended May. So inflation has seen some kind of decline. And the US 10-year Treasury note, which is the one of the largest traded instrument in the world, has now started coming off. It came to as low as 2.79%. Let's look at the US 10-year Treasury. So after peaking out near 3.45%, it has now started coming down. So the Fed has recently increased the interest rate from 1 to 1.75, but the US 10-year Treasury note market is already far ahead of the US Fed. They have already discounted those rise, and now because of the falling commodity prices and the hope that the inflation has peaked, it has started correcting. Now, if this continue to go down, then that will help the markets around the world. The one of the worries around the world was the higher crude oil prices, so that also has been showing some signs of a correction in the last fortnight. So from 125 odd levels, it has now come back to 110 $111, and this rise is worrisome about the for the Indian markets, but this correction is welcome. So higher crude oil prices led to a lot of current account deficit, and that led to Indian rupee going to all-time lows. So this is the chart of Indian rupee, and it has even touched uh, as high as 79 during the past fortnight. So because the Indian rupee is depreciating so much, the government has come into action. The government has now decided to impose the duty on import and also started taxing the exports. So the domestic crude oil producer are making a lot of money. So they have raised the export duty on diesel by 13 rupees per liter and petrol by 6 rupees per liter. So when these goods are exported, they will pay higher tax, and government will utilize those taxes to pay for the deficit. Similarly, government is trying to discourage the imports, and they have increased the import duty on gold from 10.75% to 15%. Now let's look at the performance. So the last fortnight, as you can see, the international markets have seen some kind of recovery. Dow, S&P, and Nasdaq are up by 3 to 4%, and other international markets like Hang Seng has also started coming up. Similarly, for Indian markets also, we see that the Sensex, Nifty, Midcap, Small Cap have had some kind of recovery. Even after this recovery, as you can see from the screen, For the month, we are still down by 5 to 6% for the international markets. Similarly, Nikkei, we are still down by 5%. And Indian markets also, as you can see from the screen, we are still down by 5%. So last fortnight, we have seen some kind of recovery, but after that recovery, we are still down by 5% for the month. What are the key sectors? So if some of you may remember that we had highlighted that we are bullish on auto, and auto is one of the outperforming sectors for the last fortnight. FMCG has also done well. Metals are still struggling, and it is one of the only sectors which has not done that great. Over the month also, auto and FMCG are outperforming sectors. They continue to do well, and metals are the one of the worst performers, down by 14%. Now, over the next fortnight, tables can turn. There is possibility of some kind of a short covering in these banking and metal stocks, so be aware of that possibility. So, on the 4th of July, US markets are going to be closed on Monday again. Last fortnight also, we had that kind of a Monday holiday in US markets. The Independence Day holiday will be celebrated there. On 18th July, Japan is going to be closed. Amongst the other important days, 6th of July, we will get the minutes of the FOMC minutes. So there we will know what kind of interest rates hike are going to come in the month of August. Market is still expecting 75 basis point hike, interest rate hike in August. Non-farm payroll and unemployment data will come on the 8th of July. On 12th of July, India's IIP and CPI data will come in. Now I will invite Nagraj to share views from the technical charts perspective. Over to you, Nagraj.
Good morning. This is Nagraj Shetty, one of the technical research analysts at HDFC Securities. Today we will discuss about the technical market outlook. We will study the charts in details from a smaller time frame to a larger time frame charts, how the patterns are unfolding, and finally we will discuss about the conclusion about the market, how things pan out for the next week and the next 1 or 2 weeks. Now, without wasting any time, go on to the next slide. On the daily time frame, yesterday on Friday, market has showed a significant upside recovery from the lower levels, and there was a hammer type candle pattern, which is though not a classical hammer, but the long lower shadow, which indicate that market has showed a significant upside moment from the intraday lows, and which indicates that more upside could be in store. Yesterday's hammer type pattern also signaled that there is a false downside breakout of the range. Market was moving in the range around 15,700 to 15,900 levels, and yesterday's move below 15,700 levels and the sharp recovery indicate a false downside breakout. This false downside breakout signal that bulls are back into action for the short term, and more upside could be in store. And on the weekly time frame chart, after a sharp upside bounce of last week, Nifty showed a consolidation in this week and sustained above the support. After the upside regaining the strong area of 15,700, 750 levels, yes, last week's intra-week movement has moved below this level, and finally Nifty has crossed above that level. What we can see here, a small body negative candle was formed, a long lower shadow. Friends, technically, whenever such long lower shadow indicates that signal that buying is emerging from the lower levels. Hence, not only the strong area of 15,750 are taken out on the edge, but also this signals that there could be further upside in the market. But what we can suggest, what the whole chart pattern is suggesting, that on the weekly time frame we can see the lower tops and lower bottoms, which is a negative setup, negative pattern as per the dose theory. This indicates the larger term, bigger term trend remains intact. This lower tops and lower bottom signal that the long term market, medium term market is still negative. There is no turnaround story, but at the same time, these pullback rallies are offering till the lower top formations, smaller upside bounces for traders and the investors for exiting long position at the higher levels. This is what exactly happening. Last time we have seen this 3 weeks of up move. Previous to that, 4 weeks of up move. After previous to that, 4 weeks of up move. After this such a strong upside bounces of 4 weeks, now the upside bounces is diminishing. It is reducing to 3 weeks. Last time we have seen 3 weeks, now we have seen 2 weeks. This is suggesting that on the larger time frame, market may be losing its stem and losing its strength to show upside bounces and sustain at the high. But at the same time, the lower bottom formations always gives a chance for a upside bounces for a traders. So on the monthly time frame, friends, monthly time frame, this is a larger time frame, and over the last 8-10 months, 7-8 months, Nifty has been declining continuously with the formation of lower tops and lower bottoms. These lower shadows of last 2 months back, March and May, particularly March and May month, indicates the sharp upside bounces as we have seen in the weekly time frame chart, and monthly time frame is also indicating May and March 22 are the significant upside bounces for the month, and this time the upside bounce was lagging. The long bear candle was formed on the monthly time frame in the month of June, and market is placed at the support of 20 period EMA around 15,700 to 15,800 levels. This is very important for the market to regain the strength, and a move below which signal more weakness would be on store. So move on to our next slide. We can discuss about the Nifty small cap, mid cap indices. This is Nifty mid cap 100. This is Nifty small cap 100. What is evident from the chart is same what has happened in the Nifty, the same lower tops and bottoms. Recently, we have seen a formation of lower bottom here in the mid cap, lower bottom here in the small cap. After that, upside bounces have started. A similar kind of a pattern, like hammer kind of pattern, was formed in the small cap, and the sector moved up, and similar kind of a reversal pattern was formed in the mid cap as well, and the sector has moved up. There is some scope for this small and mid cap indices to show some upside, but the larger picture remains intact. As I told you, this signal, as long as this signal remains, we say that whatever the upside bounces could be short-lived, going to be a lower top formation. That is going to be an opportunity for exiting long positions or placing a strict stop loss at the higher levels where we are likely to see further decline. There is a higher possibility of a further decline. But in overall study of the broader market in last week revealed that we have seen NSE, FMCG and BSE infra are the two significant sectors. We have seen NSE, FMCG sectors has moved up very well, and the stock participants, HUL, ITC, Dabur, Marico, McDowell, these participants are looking good for the chart for a positive bias. And in infra side, it has continuously showed the lower top, lower bottom, and the Reliance Power Grid, GIL and Bharti showed a negative bias. So the friends, now the whole we have studied from daily, weekly, monthly time frame. We have concluded that the short-term trend of Nifty continues to be range bound, but Friday's upside recovery from the lows hint at a possibility of some upside bounce in the market is left. A sustainable up move. We have seen market was moving in the range at the resistance of 15,900, 950 levels over the last period of time. A sustainable move above 15,900, 950 levels could bring bulls back into action, and that could possibly pull Nifty towards the next overhead resistance of around 16,300 to 16,500 levels in the near term. At the same time, we have to be cautious. Long-term trend of the market remains negative. Any decline from the higher levels towards below the 15,600 levels or 15,500 levels could bring more weakness down to 15,100 levels. Presently, we will discuss about the pullback rally. Market is in a forming a lower top, and we are likely to see further upside. A move below 5,900, 950 levels can pull the market towards the 16,300 to 16,500 range, where Nifty is going to encounter a strong overhead resistance. Long-term trend remains negative, as we have discussed the market, and we expect Nifty to reverse down from the lower highs. As we have seen the pattern unfolding over the last many months, over the last many weeks, that market has failed to sustain that lower highs, and this time also we are expecting Nifty to reverse down from the lower highs, and one may use this current upside bounces to lighten the long positions or to create fresh short positions when the market turned reversal at the higher levels. That will give us a good opportunity to capture the downside in the market. The broader market indices like mid cap and small cap remains intact. They are into a small pullback rallies, and at the higher levels, a selling pressure is likely to emerge. Friends, this is a brief about the technicals aspect, and we have discussed about the how the outlook for the market for the next 1 or 2 weeks.
Thank you, Nagaraj. Now let's hear from Ajit and learn about what markets are saying from the derivatives data. Over to you, Ajit.
This is Ajit Naik from Technical and Derivative Analyst. The outlook, I'm here to present you the outlook on the market from derivative point of view. So now, let us see how the open interest has built up in Nifty and Bank Nifty. So we have seen minor long build up in Nifty futures, where we have seen open interest going up by 4.43%, while Nifty futures rising by 0.19%. And also long build up in seen in Bank Nifty futures, where open interest has gone up by 10.92%, with a rise in open interest and the Bank Nifty future rising by 1.09%. The open interest data, what does it suggest? It suggests that we have seen a good put writing at 15,500 to 15,400 level, and also the call has been written at 16,000 to 16,200 level. That was happened in the 7th July expiry. So what we can see from here is that 15,000 to 15,400 is going to be a crucial support in coming weeks. So this is the open interest data. We can see how the open interest is built up in various strike prices. So it is very clear from the chart that open interest has built up in 15,400 to 15,000 level, and the major direction of the market on the lower side will be taking support at 15,500 level. See, on the contrary, 16,000 to 16,200 level, there is major open interest on the call side. So this is pink color line. We can see that is on the put side, and the blue color is suggesting the call side. So call side also. So this kind of, whenever this kind of phenomena occurs, we can assume that market is going to be a range bound for the next coming few sessions. Why? Because on both the side, 15,500 and 16,200, there is huge open interest buildup. So whenever there is a huge open interest buildup, both call writers and put writers are active in the market. That is what we saw in the last few sessions in the market, that market was in a range bound. Even though we were seeing a gap down kind of action every day because of the global cues, but Nifty and Bank Nifty was managed to recover from the lows. Why? Because on the lower side, there is a nice open interest buildup on the put side in 15,400 level, and similarly it was not able to take out the resistances. Why? Because call writers are also active on that side, that is 16,000 to 16,200. So what does now FI data suggest? So FI's data, they have been like shorting the market since long. So even this week on Friday, they have created a short buildup in the index futures, where they have sold net of 543 crore, while open interest going up by 13,913 contracts. And on the other hand, the important thing is they have built long buildup in the stock futures by buying 318 crore, while open interest going up by 40,726 contract. The most important crucial aspect from the FIS point of view, what we have to look at is that the FIS long to short ratio has now slightly starting to picking up. That is 0.17 to 18 level. It means they are in a mood to cover their shorts. So this is a kind of oversold level if we see the historical data from historical point of view. Now they are ready to cover up their shorts. If they start to cover their shorts, we might see a good short covering rally in the Nifty. So this is how it started from June 3rd, from 0.65 now has come down to 0.17, which is the lowest of all, and now picking up. So if this trend continues, we can see that Nifty may show some rally in coming weeks. So what is the outlook for the market? So outlook for the market is we can go long only above 16,000 level. Why? Because there is a huge put writing call writing on the 16,000 levels. Once that level is taken out, we can see a good rally. So, and we are also witnessing some long build up now in the Nifty from Friday. So that is also supporting factor. So once 16,000 is taken out, and long build-up is going on, and short covering will be there in the place. So now Nifty can go up. So keep in mind, above 16,000 you can create a long position with a stop loss of say 15,800 to 15,500 kind of a level. Why? Because there is put writing in those levels. So broadly speaking, we will be in a range of 15,400 to 16,000 level. And this market is going to be a very stock specific approach. You have to give a stock specific. Many stocks can give a fantastic phenomenal result if we clearly watch the technical and combine with the fundamental pattern. But we have to be a very stock specific. It will not be a whole market breadth will be supporting. Few stock will be going to give a fantastic phenomenal result. So what is the outlook for Bank Nifty? We can go long about 34,100 level. So once 34,100 level is crossed, we can see a short covering rally in Bank Nifty as well. And on Friday, we saw that it was showing some strength. So keeping those things in mind, the level and the behavior of the market, we can go long about 34,100 level. If that level is crossed, we can next level will which it approach will be 34,900. Thank you, everyone.
Thank you, Ajit. Now let's discuss the way forward. What is the way forward? Many of you know, and we did cover this in our last video also. We have come out with a strategy note, how to invest in volatile times, on June 16. Here we had covered three sets of stocks which can be avoided. The stocks that have good growth visibility but are looking still expensive, stocks that have seen their best days but are yet to see the unwinding of the positions, and the stocks that are trading fairly steep valuations and need to be avoided. So we did come out with seven high risk stocks and seven medium risk stocks which can be accumulated according to your asset allocation. If you are having cash to accumulate these stocks, this is the list of stocks you should pay attention to. So that's all from our side. Thank you for watching this video. I hope you find this video series useful. If you have any comments, you can share it with us by sending us an email or on our WhatsApp messages group. Thank you and have a great weekend ahead.